Hi everyone and welcome to this recording. We are going to discuss briefly what are the different mishaps that have happened because of derivatives, what we can learn from them and how to deal with it. Okay. So trading in derivatives and especially taking positions in derivatives is very dangerous. It's very risky and the losses can be big. So some of the big financial losses that have been caused because of derivatives can be Allied Irish Bank that lost around $700 million, Amaranth that lost around $6 billion. So Amaranth basically traded on natural gas prices and they got the natural gas prices wrong and they lost around $6 billion because of that. This is famous. Bearings is famous. There was a rogue trader in Bearing. He alone was responsible for around $1 billion of loss. So what was he doing? He was betting on Nikkei's prices. Nikkei is a index in Japan. So he was betting on foreign future prices of Nikkei and he got it wrong, and there was a lot of it's a big scandal and there is a movie about it called as Rogue Trader. So he got it wrong, he did some wrong practices and he lost $1 billion to Bearings and he almost collapsed the bank. That was the one of the oldest banks in UK and it almost collapsed because of him. Then there is a famous case of Enron counterparties that lost billions of dollars because Enron cooked their books. So that resulted in a lot of losses to the people who were providing services to Enron. Kidder Peabody $350 million loss. That's again the treasury department of that company. It's a non-financial company, so it's not a bank. So it lost around $350 million because of that. LTCM lost $4 billion. It was doing a strange strategy where it was buying two assets. So it was doing an arbitrage strategy where it used to buy assets that should have same prices but they were not having the same price. So let's say it is trading on US dollars, so it would buy US dollars in two different markets thinking that US dollars should trade at the same price. The logic was right, but the big difference was it was trading in liquid markets and illiquid markets. So it was taking one position in liquid market and one position in non-liquid markets, and even though it was making profits, it was not able to square it off, and that resulted in big losses of $4 billion. Midland Band lost $500 million. Then it's an Italian bank, Society General, that lost $7 billion. Subprime mortgage, like, the credit ratings were wrong, they did not account for all the risk factors and people just believed those credit ratings blindly and people lost billions of dollars and it led to 2008 recession. UBS lost around $2.3 billion again, right, trading, and it continues. Allied Lion lost $150 billion. Gibson Greetings, which is a greeting company, the treasury department lost $20 million trading on derivatives. Hammersmith and Fulham lost $600 million. Metal Shaft lost 1.8. This is a famous example. So there was a trader in Orange County, California. He was trading on financial derivatives, especially interest rate derivatives, and he was trying to predict interest, like future interest rates, and he had a big bet that interest rates would not rise. So he lost around $2 billion in 1 year on trading, and before he lost $2 billion, like couple of years before, he was making good money for California. So risk management turned a blind eye towards him because their whole budget depended on him performing. So he lost around $2 billion in 1 year and the budget was out for a toss. Procter and Gamble lost $90 million for that. Shell lost $1 billion, and Sumitomo is a Japanese company that again lost $2 billion trading on derivatives. Now, what are the reasons why people are losing a lot of money? So lessons that you can derive from all these losses: risk must be quantified and risk limits should be set. So if you're a trading firm and you're trading in derivatives, then you have to look at risk for each position and you have to set a limit for that. Now sometimes what happens, like in the trading firm I work with, the hedge fund I consult with, we have different traders, right? So each trader has performs differently. Some of them are called as star traders. Now if the star trader starts to perform, people generally turn a blind eye. They give him more money, more capital to play with, they ignore his risk, and that is wrong. Because like, to perform randomly, there is a 50% chance you will get it right if you are speculating. So you may get it right 10 times in the row, right? But 11th time that you trade, you may have a lot of capital and lose all that money. So it is important to factor in the risk, to quantify the risk, right? So there are various ways to do that. How much money can you lose, and like area, like risk under like total quantity of money that you lose, then percentage losses can be looked at. All those risk models are there, and you also have to set how much risk is permissible. What are the risk limits? Exceeding risk limits without authority is not acceptable even when the profit has resulted. Especially true for treasury. Treasury's responsibility is to hedge risk. Their responsibility is not to make profits. But increasingly, treasury have been looked as a profit center. So that should be avoided, and even if profit is resulting because of taking risk, you shouldn't allow that. Do not assume that a trader with good track record will always be right. He can be wrong, and can be wrong big. Be diversified. Instead of taking one position, focus, like if you're a trading firm, focus on different assets, take positions into different assets so that you're not dependent on only one thing. Scenario analysis and stress testing is important. Play out different scenarios. So let's say I'm trading on Bitcoin. I'm trading on Bitcoin futures. So I have to look at different scenarios. What happens if Bitcoin tanks 30%? What happens if Bitcoin goes up 30%? So all these scenarios have to be played out. Then monitor trades. Lessons for financial institutions. So if you're a financial institution, you have to monitor trades carefully, right? And you have to separate departments. So front office and back office. Front office is people who trade. Middle and back office is the risk management and reporting. So that should be separated. A trader should not be responsible for risk management and reporting, because then there is a bias that he can have, right? He can play the system. That was what happened with the rogue trader who almost collapsed Bearing Bank. Models can be wrong, so do not only depend on models, right? And this was specifically true. There were a lot of risk models in 2007, but all of them were wrong because they all dependent on credit ratings, and credit ratings did not capture the risk properly. Be conservative in recognizing inception profits. So financial institutions who sell derivatives, sometimes they make profit right at the get-go, but that profits should be recognized over the years or over the lifetime of the derivative, rather than having the profit right at the get-go. Do not sell clients inappropriate products, so that should be avoided. Beware of easy profits. There is nothing easy in the world, and especially true in derivatives. Liquidity risk is important. So sometimes you are taking positions in liquid assets and illiquid assets and pricing them like they're liquid assets. So that has to be factored in. And especially when markets fall, the liquidity evaporates, right? In some products, there is no liquidity. So if you buy a put option on some illiquid stock and the stock goes down, you are making profits, but there is no way to capitalize on that profit because trading may halt. So you have to factor that in. There are dangers when many are following the same strategy. So this is an example of portfolio managers in 1986, 1987, there were a lot of products that were launched based on stop losses. So these portfolio managers, they marketed their product that loss cannot happen. So each time the market went up, they used to sell a little bit of stock, and each time the market went down, they used to buy a little bit of stock. That's how they managed their risk. But everyone started to do that. So when market started to fall, everyone started to sell their stock. That's why the fall aggravated. So that is something that you have to avoid. If everyone is doing the same thing, if everyone is buying put options on certain stocks, then the profit possibility is very less, the hedging possibility is very less. Beware of potential liquidity problems when short-term funding is used for long-term needs. Especially financial corporations, they roll over, so they take money for in the short run and they play it in the market in the long run. So if you are doing that, then you have to focus that liquidity problems may arise. Market transparency is important. So if the strategy is not transparent, do not put your money into that. Manage incentives. So traders should be incentivized once the position is complete, not when the position is currently in play, right? So the bonuses, the profit should be staggered, they should not be in one go. Never ignore risk management even when times are good. Then for non-financial corporations who hedge their risk using derivatives, it is important to fully understand the products you trade. So if you're not, like, there are derivatives that are like, recent example is Alberta government, right? Alberta is a province in Canada, and it was hedging its risk on oil by doing some derivative, and it lost billions of dollars doing that because oil prices crashed, the position become worthless, and then it lost billions of dollars for doing that. So that should be avoided. If you're not comfortable, if you're not understanding the product, then you shouldn't trade with it. Beware of hedgers becoming speculators. If your job is to hedge risk, you should not speculate on the prices, right? So try and avoid that. It can be dangerous to make the Treasury Department a profit center. Treasury Department's role is to hedge risk. It should not be looked as a profit center. So this was a short recording. So thank you for listening, and see you in the next one.